Hello and welcome. Today we're working on a three-statement financial model. It's a dynamic model built on assumptions. We're going to do an income statement, a balance sheet, and a cash flow statement. So if you've ever wondered how to do a financial model, building financial statements, this is your video. If you're new, my name is Jeff from Finally Learn. Everything I do basically is teaching how to do financial information using Excel. So what I have is, I have a three financial statement model, and I have an income statement. I've just started with the outline. I haven't done any of the numbers. I will show you that we have a balance sheet. I have given a very beginning balance sheet, but we'll do 5 years all step by step. I've got a cash flow statement for the 5 years. And then at the bottom, here's how we do the income statement and the balance sheet. I have a set of assumptions. I'm going to get rid of these that I've worked on right here. And so everything that's in a green cell is an input, and it's okay to change that. In fact, the only number I've entered, will enter in this is the inputs, and everything's going to be built on a formula. So it's dynamic. You can change the growth rate. You say, oh, that growth rate is way too low. I'm going to make it 8% each year. Or you think, I'm in a mature industry, it's only going to grow at 2% per year. That's fine. You can adjust it. Once we have the model built, then everything can be changeable, and you can put your own numbers in. You can put 3.25% and be happy. You don't have to use 4.0. Okay? So let's get started with our income statement. And right here is our income statement assumption. So I'm going to do something, you may not have seen this before. I'm going to do a split screen here. And so if I go to the view ribbon, so you might be on the home ribbon, go to the view ribbon and split, and it'll split. You don't have to do it halfway or whatever. In fact, I'm happy to move mine down a little bit. So here's my assumptions, and I can go to the very top. I need to look at the income statement. So instead of having to scroll around quite as much, you can do a split screen. So you see I have a split screen, and then when that confuses you, take it off. But if it's helpful at the very beginning, that's awesome. All right, so here's what we have. We have an income statement. I'm going to do it for 5 years, starting right now. So I've made the assumption that we have 5,000 units sold prior to this year, and it's going to be $45 each. Now, what is the growth rate for the units sold? Well, it's going to be down here. Do you see it's 4%? So I'm going to take the 5,000 times, and to grow it by 4%, I'm going to multiply it times 1 plus the 4%. So start with our bracket here, 1 plus 4%. So that's the nice way to increase it by 4%. So if we increase our sales by 4% for units, it's going to go from 5,000 to 5,200. And I can copy this across. I can use right click and say copy. Now I'm on a Mac, and I know a lot of you are on Macs, a lot of you are on Windows. So I can do Command C, or Windows people, Control C, and then Control Paste. But there's a faster way on both methods, both Windows and Mac. If you'll look at your cursor, it's an outline, but if you move to the right corner, there's a little dot there. Move to the right corner. Do you see the dot? The cursor becomes a solid. If you'll hold down the left button on your mouse and drag, so click and drag, then that moves the copy and paste, and that moves the formula. You see the formula is going to be the previous year times 1.04, whatever's in that cell. Now, it could be, you might say, hey, there's no growth that 5th year, and you'll see that it shows no growth. Everything's built on these assumptions. Nothing is going to be typed in without these assumptions. Now, let's say our sales price grows by 1% every year. That's our assumption we're doing here. Thought that would be nice. So, hey, if you like it in your model, put it in. If you think that's the craziest thing I've ever seen, leave it out. But I think that's helpful. Over time, prices go up. If I'm talking to anybody that's young, over time, prices will go up. Older people, if I'm talking to you, you know, you're nodding your head. Over time, prices go up because of inflation. All right, so we're going to take the 45 times, start my bracket 1 plus 1%. And we're going to say, well, the price goes from 45 to 45, 45. And you say 1% growth. And then at some point you'll say, man, I think I remember when it was 45 each. Now it's 47.30. And then people younger, they're like, oh, you're so old. Well, that was only 5 years ago, and the price goes up. Now, if we want to show inflation, you might go up by 5% a year. Then it gets to be much faster increase in prices. Okay, so for our revenue, we're going to take our $5,200 times our $45. It's $45.45, right? So therefore, our revenue is going to be $236,000. This could be in thousands, so this is really in millions. This could be in millions, so it's in billions. But let's just pretend like it's just in single dollars. So this is $236,000. And I can copy it across. There you go, copy it across. And so now we have our revenue. Now, cost of goods sold, I've got a rule for that. Cost of goods sold, we want it to be, in this case, 52% of revenue. Now, we would love that number to be lower. 48% would be better than 52. But we'll just build a model based on the 52%, and you can change your percentages later. In fact, I encourage you, change those percentages and see what happens to your net income and your cash and things like that. So we'll take the $236,000 times the 52%, and it doesn't have to be the same 52% every year, but in my model, I just made it really simple. I typed in 52% 5 times. But in your model, it could be 48% one year and 50% one year. And so you see over time, you're getting better and it's becoming cheaper as cost of revenue. All right, so I'm going to go back and put 52, 52. Now, our gross profit, here's we want to think about this. Do we want to make this number positive for cost of goods sold, or do we want to make it negative? Now, by the way, what is cost of goods sold? Cost of goods sold is the cost of our products. So it could be called cost of goods sold. It could be called cost of sales or cost of revenue. And then we have gross profit. Now, if we make it, here's one thing we can do. If we make it negative, then what we could do is just add these and we already have a subtraction. So the math is a little bit easier if we just add everything together. So I'm going to make this, go back and edit this formula and make it a negative. And then as I copy it across, all those numbers just flip to negative. Now, all I have to do is just add this up and there's my gross profit. Now, one thing I can do is I can use a shortcut. If I go to the home ribbon, then I can use the auto sum, and I can do that, and that gives me the sum of each of those columns, which is pretty amazing. Right here, the sum of that column. There's a shorter way, there's a shortcut. If you've been around me, you probably know what I'm going to say. What you could do is you could use a keyboard shortcut. All right, Windows people, it's going to be Alt and equals. So hold down the Alt and the equals. I've selected everything. It's going to take the contiguous cells above and just add them together. I'm on a Mac, so therefore it's Command-Shift-T for total for me. And so therefore I've got the sum, which is going to be a subtraction, right? So our gross profit is 113, 119, all the way to 138,000. Now, SG&A, I've got a rule down here. So it's going to be here 32%, this number times 32% of revenue. We're going to copy it all the way across. Let's make it negative. And we'll copy it all the way across. I guess the nice thing about making it negative is somebody's going to see, oh, by the way, this is a subtraction, right? Now, depreciation, I don't have that number right now. We're going to have to do the balance sheet. So let me put in a -1 just so we can, let me put a -1,000. How about that? Just so we can see that that number is subtracting correctly. And I'm going to copy this across. Now, that number is not going to work, so we could highlight that, and we know we need to come back to it. So let me highlight this, and I'm going to highlight it, and we know that it's not going to be that number. All right, so now what I can do is I can calculate. I want to calculate the 113 minus the 75 minus the 1,000. Okay, so let me do 1 and I'll copy it across. Okay, just 36,000, does that work? So if I highlight all those three things, 36,000 is my number, and then I can copy it across. Now my interest expense, same thing. I don't know how much I've borrowed right now because we're just working on the income statement. So my interest expense, I don't know. So let me put another negative 1,000. In fact, I'm just going to copy this. We know it's negative 1,000. Now, I've typed in those numbers. I know we don't want those numbers. And so we're going to use our model and calculate what our depreciation is. We're going to calculate what our interest expense is, and we're going to put it there. But I'm just highlighting them so I can remember, by the way, we have to change those numbers and they won't be highlighted anymore. Now, our earnings before tax, we have operating profit minus interest expense, and we'll have the earnings before tax, or EBT. All right, I want to do my sum here, 35,000. I'm going to copy it across. So what we have is we have gross profit, and then SG&A is selling, general, and administrative expenses. These are operating expenses, and sometimes you'll see them called like G&A or S&A, and so a combination of those, but selling, comma, general, comma, and administrative expenses is kind of the full title, and people abbreviate that SG&A many, many times. All right, then we have depreciation. Depreciation is going to be the allocation of the cost of a long-term asset like machinery or equipment. Now we're down to earnings before tax. So operating profit is earnings before interest and taxes. That means the next two things we take out are going to be interest expense and taxes. So our taxes, we have a calculation. It's going to be the rate. It's going to be whatever the EBT number is, the earnings before tax, times the tax rate. Here it's 25%. And I need to copy it all the way across. And so therefore our net income is going to be, and we need to make that negative as well, right? So I don't know about you, but they're not giving me tax money. I'm having to pay tax money, so that's how it works. So taxes are going to be a negative number we pay. And so therefore we can take 35 minus the 8, so we have net income of 26,000 all the way through. The only thing I did ahead of time was I wrote out the template for the income statement, and then I made the lines in bold, and but we did all the numbers there together. So you can see here is what our net income is going to look like. We have two open questions here. What is our depreciation? What is our interest expense? Okay, so let's keep going. Now, one thing we can do is we can figure out what is our net profit margin. Okay, I'm going to take off the split here so I can look at things a little bit differently. So what is our net profit margin? Our net profit margin is going to be our net income divided by our revenue. So here it's something like 11.4. I went ahead and formatted it for percentages, and I made it in italics just so we know it's not part of the actual statement itself. And you see all the numbers are about the same because we made the same percentages, but also our depreciation and our interest expense are really just placeholders at $1,000 each. These numbers will update when we update the income statement. All right, now what do we want to do next? Well, we can look at our balance sheet, and our property, plant, and equipment is at $37,500. Plant assets or property, plant, and equipment. Sometimes it's called fixed assets. So this is land, buildings, equipment, trucks, cars, computers, furniture, things like that. So a lot of times machinery and equipment. All right, so let's go down here to the bottom and let's calculate. We can do all this if you want to. We can calculate things like interest expense. We can calculate depreciation. In fact, let's calculate depreciation. Here's what we have. What is our current amount of plant assets or capital expenditures? CapEx is a cool way of saying capital expenditures. People don't want to say that whole thing, so they say CapEx. stands for capital expenditures. These are long-term assets, so capital assets. And they're also called plant assets or fixed assets. And so we already have a number there. We pointed to it. It's on our balance sheet. We're going to grab the property, plant, and equipment of $37,500. Okay. All right, so our current plant assets is $37,500. And we're assuming we're going to purchase 20,000 more, 22,000, 25, 30, 35,000. Now, those are not expenses until we use them up over, in this case, 5 years. So here's what we need to do. We need to calculate the depreciation for each of these calculations, for each of these assets. So if we buy this asset for $20,000, well, how much is our depreciation the first year? Well, it's going to be 20,000. I'm going to make it an absolute with F4, so dollar signs, times, divided by, I'm going to use the 5 years, so I'm going to make that absolute. And so the 4,000 is going to be 20,000 divided by 5, and that's going to happen for all 5 years. So over 5 years, we're going to allocate the cost of that 20,000 over 5 years. That is depreciation expense each year. All right. Now, when we buy 22,000, we'll do the same thing. So 22,000. I want to make it absolute here with F4 divided by the 5 years, which is also absolute. So that's 4,400, and we'll do that for the next 5 years, but only 4 years for our model. Our model goes to 2030. All right, then we have in 2028, we buy $25,000 more. So I'll do this quickly here. So it's going to be 5,000 each of the 2 years, each of the 3 years rather. Then we bought 30,000. The other way we could do it is just say 30,000 divided by 5 and just point to that number. We could just say, hey, just use that number previously, the 6,000. And then the last one, it would be 35,000 divided by the 5. And that's 7,000. So what we have is, what is the total depreciation for the new assets for 2026, which is our year 1? So we can take the 4,000 and then add it all up each year. So 8,400, 13,400, 19,400, 26,400. So this is a cost that we expense over time. Now, our prior assets, we have 37,000, and we're going to divide by 3. Now, we can make that absolute if we wanted to, so we can go back and highlight everything, make it absolute, and it's just going to be for the next 2 years. So 3 years total, and then this year will be 0, and that year will be 0 based on our calculation. All right. Now, our new asset depreciation is going to be the 4,000 all the way across, then the 8,400, so on. So what we have, we're going to have our total depreciation is going to be 16,500, 20,900, and so on. So this is our total depreciation. We can now put this way back at the very top in our income statement. So let's do that. We have depreciation now, so let's use that all the way at the top. So our depreciation is not going to be negative 1,000. It's going to be equal to negative, and go all the way back down, 16,500. So that is our depreciation we're going to do for the very first year. And then we would move it all the way across, copy it all the way across. That's our depreciation numbers. And you see our net income goes down, and also our net profit margin goes down. All right. So what we have is since we have the depreciation calculated, I'm going to take off the highlight. because that's a correct number now. We actually have built that number in our income statement. All right, so let's do the same thing with interest expense. Down here, we've got a calculation we can do for interest expense. We're going to assume percent of revenue for a lot of these things, but let's get down to this right here. What we're going to have is we're going to have a line of credit, and we can play with a line of credit. Let's just say we can borrow money or we can repay money, and right now our estimate is we're going to borrow $1,000, $1,500, $1,800. Now remember, this could be in thousands, so this is really 1 million, 1.5 million, so on. And let's assume the short-term interest is 5%. We could change that. It could be 3.5%, could be 6.7%. We can use realistic numbers. It doesn't have to be the same every year. And then we have long-term debt. All right, so what would be the short-term interest? Well, 1,000 times 5% is $50. And then all the way across is going to be the short-term interest. We're going to do the same thing for the long-term debt. We're planning to borrow $35,000. Let's say it's in thousands, so 35 million, 36 million, 38 million, so on. So it's going to be 35 times 8.2%. I got tired of using 7%, 8%, so I did 8.2. And then all the way across. So what we have now is we're going to have the total interest expense all the way across. And so now we can plug that in to our income statement. We're going to be finished with our income statement. We're going to use this number right here, D88. Okay, so let's go to the very top. So we can say, hey, I want to use D88. I think that's the correct one. Is that 2,920? Was that our number? I think so. And then we can just copy it across. So now we have completed, I'm going to take off the highlighting, we've completed our income statement. And now we have, the numbers differ because we have a different profit. We're borrowing money, we're buying long-term assets at a different rate. So we finished the income statement. We're more than halfway done, but our income statement really includes other things. So the balance sheet goes by quicker. Now, let me show you on the balance sheet. One thing we want to do is we're always so concerned that our balance sheet balances. So what we're going to do is I'm going to do a little balance sheet check right here. 67 minus 62,400. And it doesn't work. So I'm going to copy this across for each of the years. And I'm going to make it in red just to warn us, hey, if it's out of balance. So here's what we have. We have our basic current assets, the short-term assets we call current assets, cash, accounts receivable, inventory. Okay. Then we have things like plant assets and total assets. So our total assets are 67,300. Down here we have the current liabilities, the accounts payable and the line of credit. We have long-term debt and we have total debt, which we call total liabilities, right? Debt and liabilities are the same. The stockholders' equity is made up of common stock, retained earnings, and then total stockholders' equity and total liabilities and equity. We're out of balance by 4,900, so what do? Oh no. Well, generally this is going to be a plug of whatever it needs to balance, so 4,900. Now in this case, I just assumed some numbers, and so that's going to be the number. If all the other numbers are right, then it has to be 4,900, and you saw how we got that. Okay. Now to build, we're going to start building from scratch and everything. One thing we won't know is how to do cash quite yet. So let's do accounts receivable. Accounts receivable, I'm going to go back and do my split screen here. Now the accounts receivable, we've got a assumption way down here on the balance sheet. We're assuming that receivables are going to be 3% of revenue. Now, do we know revenue? Yes, we do. So we're going to say, I'm going to take revenue, my total revenue at the very top, times 3%. That number could be higher, it could be lower. we're just starting with an estimate. You're going to have to tweak and find the numbers that work for you. Or go back and look at your last year's financials, the last several years, and you'll see how that works. Now, we can copy this certainly all the way across, or we could wait and do several things together. Inventory is going to be a percent of cost of goods sold. So inventory, we're going to take cost of goods sold. Now, it has a negative, so we don't want it to be a negative. We'll adjust that in just a minute, times 5%. There's nothing magic about 5%. We could change it. But let's make it a negative, so it makes it a positive. And our total current assets then will be the combination of all those numbers. We don't have the cash number yet, but so far we have this. We can copy these across, and the formula is going to include the cash when we get it. All right. Now, plan assets, we do know plan assets, right? It starts at $37,500, and then it goes to, it increases by $20,000. Okay, so we need to spend a little time calculating this, and we'll take it off of the split screen. All right, so depreciation, here's what we have. Okay, so let's calculate ending plan assets. So what is the ending plan assets for the previous year? We know it is the $37,500. That's our given. We have one given statement, and it's the balance sheet. Okay, so that means that for the next year, year one, basically in our calculation, that's going to be our beginning plan assets. Our capital expenditures, or the purchase of plan assets, is going to be $20,000, and our depreciation is going to be a negative $16,000. So you see why we have to do all this in an order, and so therefore we can do this as the sum of all that. So now our ending plan assets are going to be $41,000. We should be able to just copy this all the way across and have the numbers that work out. So at the very end, I've printed out a solution. So let me check my solution. We should have ending plan assets of $37,500 is where we got started. It's going to be $41,000, $42,100, $41,200, $51,800, $60,400. Looks like that's correct. We're happy with that. So now we can plug it into our balance sheet here at the top. So a lot of little moving parts, but we're happy with that. We're going to say equals 41,000, and we're just going to copy this all the way across. And then we can take our total here, 13 plus 41 is going to be the total assets. Now when we have cash, let me put just a $1 cash in there so you can see that it goes up. You can see that includes that $1, $1, $1, $1. Okay? And so therefore I'm going to make that, highlight that in that yellow color, whatever it was, slight orange, yellow, marigold, whatever you prefer. And we're going to finish up the assets part here, doing it like that. All right, so now we have our assets functioning correctly. We need to figure out our cash balance. We can do that here in a little bit. We're going to do the same thing with accounts payable, and we have our line of credit calculation. So our payables, we're going to say it's 10%. So I'm going to we're going to go to column D, D80. We could do that. So we can say for our accounts payable, it's going to be a percent of cost of goods sold. Cost of goods sold, we need to make it a negative cost of goods sold times, we said it's 10%. Payables are 10% of cost of goods sold. So therefore, this is going to be that number. And we could copy this all the way across if you want to, or we could wait till we get our column done and copy that all the way across. All right, our line of credit, we just calculated, I think, let's go back and look at our line of credit. All right, our line of credit is going to be our short-term calculation here. We're going to assume here that this is our total, right? So our total is 1,000, 1,500, 1,800. That's not the change in the line of credit or the short-term interest rate, short-term rate, the line of credit, the short-term liability, right? Is what I want to say. So we're going to assume that's the total, so we can go ahead and put that number in. So up here on our line of credit, I'm just going to point to, it's going to be the line of credit or the short-term debt is 1,000, and we can copy that across. And here what we can do is we can go ahead and calculate this as our total, right? 13,000. What about long-term debt? We can do that. That long-term debt is also going to be right here, 35,000 is our long-term debt. And we can get our total liabilities. Our total liabilities will be the current plus the long-term. Now, we're in good shape here. We could take this and copy this all the way across. Everything works out. So our last year, we've got 21, our current liabilities are going to be, 17, 961, 40,000. This is correct. So here we have all our liabilities. So now we got to work on things like common stock and retained earnings, and then we need to work on the cash flow statement. So common stock, we're going to assume that we go from 20,000, and here we're going to say we have 21,000 of common stock, and we're going to move that all the way across. Okay? Now, retained earnings is going to take a calculation that we need to make. So down here we have another section. We have our income statement, balance sheet, we have our depreciation, we have retained earnings. So let's do some calculation on retained earnings. So retained earnings, the ending retained earnings is going to be on our balance sheet, and it is, ending retained earnings is going to be the 4,900. Remember that number, 4,900? We had to make our balance sheet balance. By the way, our balance sheet is not balancing right now. We know that, so we're not finished with it, but that check is running and making sure we know what's going on. So 4,900 is our beginning for the next year. What's our net income? Well, our net income is, we've calculated net income to be 13,000. We copy that all the way across. Our dividends are going to be a negative number, so negative, we have dividends right here. Our estimated dividends are going to be 10,000. Well, we're paying out dividends, so that's going to be negative 10,000. So here we can do a total and get our ending retained earnings. We can copy this across now because we built everything with a formula. And so therefore we have ending retained earnings, we add net income, we subtract out dividends, and what we're going to have is we're going to have the ending retained earnings all the way through. All right, so this looks like these are correct. There's no more changes. We know what our beginning retained earnings is, we know our net income, and we know our dividends. So now we can drop this in retained earnings as the number on the balance sheet. All right, so here's our retained earnings. We're going to go down back to where we were. We can see it's that number right there, and we'll copy it all the way across. Now our total stockholders' equity is going to be those two numbers. We can copy that across. Our liabilities and equity are going to be the 42 plus the 29, so that's going to be 77,000. 985. Copy it all the way across. Now, are we finished with the balance sheet? Let's look at the balance sheet for a minute. We are not finished. Why? Well, we don't know our cash. However, let's think about this for a minute. Let's say that instead of having $1, we don't have anything. It's zero. If we know everything, we know all our assets, we know all our liabilities, and we know our equity, and we're out of balance. The only thing we don't know, we're out of balance by cash. This is going to be our cash number, correct? Now, I'm not going to plug that number in. I'm going to have a way to calculate our cash, but that's going to be our cash number. If we know everything on the puzzle except one thing, then we know that number, okay? So our cash is going to be $23,750, and it's going to go right there, okay? Now, we need to work on the cash flow statement, and then all the way at the bottom, we can calculate cash directly. So let's do it two different ways to make sure you understand how cash flow works. We have a statement called the statement of cash flows or the cash flow statement. So let's just build this and let's show what each item means. So what's our net income? Our net income is given, well, we calculate it's not given, but now it's given on this problem. So it's $13,796. One of the first things we do is depreciation, remember, is a non-cash expense. So therefore, we're going to have to add it back. Remember, if we look at our income statement, what we have is, if we take this number, it includes all the numbers above it. It includes a negative amount of depreciation of $16,500, right? Now, was that a check we wrote? Was that a payment that we made? No. This is just the allocation of our capital expenditures over time, or our allocation of our plant assets, like a machine or like a truck. You buy a truck and you use it out over 5 years. The usefulness of that truck goes down, so we allocate the cost over its life. We're not writing a check each year for depreciation. So depreciation is a non-cash expense. So here's what we've got to do. We've got to add it back. So I need to put a negative, because a negative makes positive. You know, just like two wrongs make a right, or I guess two wrongs don't make a right. So don't listen to me. So we're going to do depreciation and make it positive. Two wrongs make a positive depreciation. How about that? So the change in accounts receivable. Now, we're going to have to do a little math on this. We're going to have to figure out the change in accounts receivable. All right, so let's look at, I'm going to do the math here up here. Accounts receivable, it goes from $6,800 to $7,090. So what we're going to do is, we need to figure out, is that change is like $290, agreed? Is that change going to be a positive because we received more cash, or it's negative because we paid cash? So you have to figure out what's going on. Well, accounts receivable goes down, we receive cash, and so anytime an asset goes up, we're going to say a cash goes down. So we're going to take the $6,800 minus the $790 and say that's a decrease in cash. So that's a decrease in cash. The next one, inventory. If inventory goes up, then we're buying more inventory. And so here, inventory goes up, so we're going to take the $4,600 minus the $6,145. That means cash goes down. We're buying inventory. Now, accounts payable is flipping it. Accounts payable, are we paying money? So accounts payable, it's going to be a little bit different. We're going to say, hey, we're going to take the change in accounts payable. It goes from 11 up to 12. That is okay because we have not paid cash, so therefore we're conserving cash. So therefore the net effect is the cash goes up. So $690. What we can do is we can now do the total here. And this is cash flows from operating activities. This is going to be $29,150, and we can copy this all the way across. Okay, So how well are we doing with our operations? Now, think about this. Our net income was $13,000, but we've generated cash from running our business of $29,000. So that's good. That's a good sign. Now, what did we pay for capital expenditures, or what did we pay for plant assets? Well, we know this number already. So each year, remember this is part of our assumptions, it's going to be here, 20,000. Okay, now let me ask you this. Are they paying us to buy the truck or the equipment? No, we're paying them to buy the truck or equipment. So therefore our cash goes down. So this is a minus. This is we're investing 20,000 in our equipment, or machine equipment, capital expenditures. So now we can copy this all the way across. All of these are going to be negative. This is just our capital expenditure schedule. So yes, we've generated cash from operations, and we've spent a lot of that cash for these long-term assets. Okay. Now, have we borrowed money? Have we borrowed money? And we have to figure out what's happening. Now, this is not going to be the total, this is going to be the change. So let's look at our line of credit, which is short term. We started with, we need to go up here, our short-term line of credit, we have started with 800, we went up to 1,000. So we've borrowed $200, so therefore our cash goes up. We've borrowed money. Long-term debt, same kind of idea. Long-term debt is going to be 35 minus 30. So we borrowed 5,000 more. Common stock, it goes from 20 to 21,000. 21 minus 20. We issued and got $1,000 more of stock. Now dividends is going to be a negative. Dividends is a minus. Let's before we do minus, let's look at the where our dividends are. Dividends is 10,000. You know that is going to subtract from our cash. So we make this a negative 10,000. And so what's our cash flow from financing activities? The total here is 3,800 as negative. We can copy this all the way across. There's our numbers. 7,500, 7,700, all of them negative. So what is our net cash flow? Our net cash flow is operating activities plus investing activities plus financing activities. That's going to be 5,350. Okay, that's just the increase in cash. The beginning cash was the number here, 18,400. And so therefore our ending cash is going to be 23,750. Now, remember I told you we already knew what that number was. That's going to be 23,750. Let's copy this across. We're finished with our cash flow statement. That's going to be our cash, wait a minute, beginning cash. This doesn't look right. So our beginning cash is going to be our last year's ending cash, correct? So now we'll copy across. All right, so I think our second year cash is going to be, let me check my numbers here. My second year cash is 26,948. Yep, that looks like it's going to be correct. So therefore we can say this is going to be what our cash is. So at the very top we can plug in 23,750. And we can copy it across. And we can say no fill because this is our numbers. Let's see if our balance sheet's in balance. Now, it's not a miracle. The balance sheet balances because we've looked at all the different changes. So let's look at one other way to do the cash. Let's kind of verify, make sure we feel good about what the cash is going to be. All right, so let's look at ending cash for 2025, the ending cash. Let's start fresh here. The ending cash for 2025 is going to be $18,400. So that makes it beginning cash for 2026, the year we're working on. What is our cash flow from operating activities? Well, let's go to the cash flow statement. Our cash from operating activities is going to be a positive $29,150. Our capital expenditures is how much we paid for everything. So that's going to be negative $20,000. We're going to have a line of credit that went up a little bit. So the line of credit is $200. And then we can just copy this down. We have the long-term debt, the common stock, and the dividends all right there together. So let's take the total here. The total is $23,750. That's our number that we had. Now we can copy this all the way across and we're finished. These are our cash numbers we calculated kind of directly rather than using the statement of cash flows. Okay? Now, a couple little things we want to do. Let's calculate. We did the balance sheet check. We want to go back and look at the net profit margin. What we see is our net profit margin, it kind of dips to 3.6%, 4.2%. And so that you might want to say, hey, let's change that where we're not spending quite as much money. The other thing is the cash goes up and then the last 2 years it goes down. Why is that? Well, you can go back and figure out, well, we're spending a lot of money on dividends. We're spending a lot of money on capital expenditures. You can start going back and say, well, what if we reduce our capital expenditures? You can go back in the model and say, well, let's don't increase our capital expenditures. Let's decrease it. So instead of going 25, 30, and 35, let's go 25, 25, and 20. Maybe we don't need all the capital expenditures. We don't need that many planned assets. If we do that, we're going to conserve cash and our cash will go up. Let's look at the debt ratio. One of the things we can do is we can figure out, well, how much debt do we have? And so let's look at total liabilities divided by your total assets. So that's a percentage. I went ahead and I think I did this as a percentage. Okay. Do I need to widen the column just slightly maybe? Why do I have, oh, I multiplied, sorry. So it's 67, liabilities divided by your total assets. So therefore it's something like 63%, and we can copy this all the way across. 61, 60, 62, 60, and then it bumps up to 71,000. Why the big increase in our debt ratio? Well, what happens is our equity goes down a little bit, from 32, 30 to 23. We're paying out big dividends and we're still borrowing money. We're borrowing more and more money. So our amount of debt as a percentage goes up. So you might want to recalculate your model because you might not want to borrow as much as you're borrowing. So back in the balance sheet, you might say, hey, look, I don't want to borrow $40,000. What if I just borrow $30,000? If you borrow $30,000, then you'll see that our total debt goes from 70% down to 66%. So this model is dynamic. It's all interrelated. If we reduce our debt, it's going to reduce our interest expense, so our net income will be higher. So everything is built in this model.